The IRS has officially released the new 2025 limits for all retirement plans. And you'll want to take full advantage of the new limits to maximize the value in your 401k or 403b, IRAs, or any other retirement accounts that you have available to you. In this video, we'll explore the compounding wealth effect of retirement accounts, and we'll also talk about how to prioritize Roth contributions versus traditional contributions for a variety of situations. There's no such thing as one contribution type being better than the other one. It really depends on your specific situation. And I'll give you the tools that you need to make that decision. If you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. Please all-out blitz that like button, subscribe if you haven't already, and drop me a comment down below with anything that comes to mind. We had 2 new channel members this week. A huge shout out to ANBU Grandad and Pinto ACR. I appreciate you guys joining the membership, and I hope you enjoy the perks that come along with it. And as always, thank you to all of you that have been here all along. I appreciate you. And then another quick shout out to the Black Friday Seeking Alpha deal that starts tomorrow. If you or a friend of yours is interested in signing up for Seeking Alpha Premium, consider using my link to save yourself $90 on your first year. This offer is particularly juicy for both new and former and returning members. All right, you know what time it is. Let's grow. 401k Basics. 401ks or 403bs are the best wealth building machines in the world for everyday people like most of you and like me. And for the rest of this video, I'm just going to keep it to 401k, but 403bs act in the same manner. They have the same limits, they roll over the same way, and anything I talk about applies to both for the rest of this video. Now, don't get me wrong, you can make more money by grinding hard and starting a business that you ultimately sell for millions of dollars, or putting sweat equity into real estate, or getting into serious investing. But if you just want to work your job and live your life, 401ks are the unsung heroes of compounding wealth in the background when you're not even thinking about it over the years. And they're one of the few investments out there that usually have free money thrown into that compounding mix. The contributions are usually pre-tax dollars, which gives you that tax savings in real time throughout the year. For example, if you put $500 a month into your 401k plan, you'll only see your net paycheck reduced by about $400 depending on your marginal tax rate. In addition to the real-time tax savings throughout the year, most companies offer a generous match. Always take free money. Using a 4% company match as an example, which is pretty normal or on the lower side these days, would put an extra $250 a month into your 401k plan for free, assuming you made $75,000. Of course, it scales with your income. To summarize this common scenario, you put in about $400 a month to ultimately get $750 invested and compounding at hopefully around 10% over the years if you have access to a low-cost S&P 500 or total stock market fund or any broad index. We'll get more into the wealth compounding in a bit, but first, let's talk about 2025. 2025 401k changes. The IRS increased the amount that an employee can contribute to a 401k plan to $23,500 for 2025. That's about a 2.2% increase in the limit compared to 2024, which was $23,000 even. That's the same $500 increase we got from last year. This year felt right, but I was shocked it was only up 2.2% last year after the whole transitory inflation debacle. The catch-up contribution for anyone age 50 or older remained at $7,500 for 2025. Secure 2.0, which was a federal law that was passed back in 2022, did increase the catch-up contribution for people aged 60 through 63 to $11,250. And for you self-employed people out there, the general limit for your employee and employer contributions to your plan was increased to $70,000 for 2025. And this is up a measly 1.4% from the nice $69,000 limit in 2024. And the $7,500 catch-up can also be applied, moving the total investable amount to $77,500 if you're 50 or older. And those that are self-employed and 60 to 63 years old get that new Secure 2.0 extra catch-up contribution of $11,250. So this moves the total to a whopping $81,250. time to dive into the other great retirement vehicle, IRA Basics. IRA stands for an individual retirement account, and they primarily come in two forms, Roth IRA and traditional IRA. And both of these account types will save you money compared to a taxable brokerage account. Traditional IRA contributions save you tax dollars in the year that the contribution was made. It lowers your taxable income, therefore increasing your net income that year. Whereas Roth IRAs save you future tax dollars in retirement because it's never taxed again. It grows tax-free and it can be withdrawn tax-free. But again, with the Roth IRA, you do pay the full tax bill based on your marginal tax rate in the year the contribution is made. Think of it as a taxable brokerage account as far as current tax year implications. There is no age threshold or limit for making contributions to your IRA, but there is a catch. You must have earned income in the year the contribution is made that equals or exceeds the amount that you put into the IRA. Now, for most people, this is not an issue at all. You don't even have to think about it. But if you have a casual part-time job or you only worked a little portion of a calendar year, it's something to consider. Here's an important piece of information regarding IRAs that you need to know. You can max out your 401k and your IRA each year. You can also withdraw contributions tax and penalty free from your Roth IRA as long as you've had it open and funded for at least 5 years. There are some nuances to this rule, and you can't take out earnings on the money. You can only take out the contributions themselves. It treats conversions in a separate 5-year window, and there's a lot to learn about it, so be sure to do your homework before you act on this. But most people can withdraw the contributions they put into their Roth IRA over the years, as long as you've had it open for at least 5 years. But don't do that because this one compounds the best, so it's the last thing you want to do. But I'm just putting it out there. 2025 IRA changes. The IRS did not increase the contribution limit for an IRA each year. It remained at $7,000 for 2025. And the catch-up contribution is $1,000 if you're 50 or older. That also stayed the same for the year. The IRS also increased the Roth IRA income limits. So with Roth IRAs, not everyone can contribute to them the traditional way. You get phased out at a certain income level. Let's hop over my screen to see what that looks like. Before we get down to the table, I think it's important to point out that your taxable income is not what the Roth IRA income limits assesses. It is your MEGI, your modified adjusted gross income, usually higher than your taxable income. That's something to keep in mind. And we'll just go, this is the 2024 right here. We're gonna scroll down to the 2025. So filing status, if you're single, head of household, or married filing separately, and you make less than $150,000 of MEGI, you can contribute the full $7,000 directly to your Roth IRA. And then there's a phase out, which drives me crazy. So anywhere from 150 to 165K MEGI, the contribution is reduced. It's somewhere in between 0 and 7,000. And then if you make over $165,000, no contribution is allowed. And then scrolling down to the married filing jointly or surviving spouse, if you make under $136,000, you can do the full $7,000 or $8,000 if you're 50 or older. And then the phase out is $236,000 to $246,000, somewhere between 0 and 7,000 allowed. And if you and your spouse have over $246,000 of MEGI, you are not allowed to contribute. Now, if you're a high income earner and you're unable to contribute to the Roth IRA, there's still a little hope out there for you. There's something called the backdoor Roth IRA. Beware that this is not for everyone out there. Doing it in the wrong situation can have major tax implications. Be sure to do your homework and speak with a tax professional before diving in. I plan to do Roth conversions, which is taking my traditional IRA dollars and converting them to a Roth IRA in retirement when my income is lower. We'll touch on the why of that one in the next section. Roth versus pre-tax examples. This is a great debate that unfortunately has many people using their gut or innate preferences to decide how to proceed. You guys know that I'm a robot, and this topic, like everything else, has been systematically calculated by bot teeps. Let's start with the high-level basics. Your decision should be based primarily on one factor: Do you think your marginal tax rate, which is your last dollar that's taxed in the highest tax bracket that you reach, will be higher now or in the future when you are retired? There are some other factors to consider in your tax planning, like Roth conversion ladders, withdrawal timing strategies, RMDs, and more. But what they have in common is that they all add ordinary income just like your job does now. So the point remains, marginal tax bracket now versus later. For example, if you're in the 22% tax bracket, that's your marginal tax rate, and you plan to be in that same tax bracket, so the same level of income in retirement, you will have to the dollar the same purchasing power, whether you go with the traditional IRA or 401k or Roth IRA or 401k. I've noticed that people generally overrate Roth IRAs because of the buzzword nature, which is true, of tax-free forever, tax-free growth, tax-free withdrawals in retirement. And all that's true, and Roths are very powerful, but it tends to get in people's head that they're way better no matter what. And let's just take a look at a couple examples of what I'm blabbing about here. I'm out on the AARP website, and they have a calculator, Roth versus traditional contributions. And I've populated these fields. So I just put current age at 30 years old, making $75,000 a year. This doesn't really matter for this because we directly input our marginal tax rate. So current tax rate in the working years is 22%. And we're assuming a retirement tax rate of 22%. So same tax bracket when we retire. Hypothetical return, I'm an optimist, and we're going to go with the 100-year average of the S&P 500 at 10%. And then our age at retirement, 65. Current annual contribution, $1,000 per month or $12,000 per year. Pay frequency, monthly, and current contribution type is traditional. All right, I'm back. I had to resize this to get the entire graph on the screen. You can see with traditional contributions at retirement, you would have $3,425,893, whereas Roth, you would only have $2,672,197. But remember, that's tax-free for life, and this one's still gonna get you at that 22%. So the purchasing power after taxes with the traditional 2.672 million and the Roth 2.672 million. It really is all about your tax rate now versus your tax rate in retirement. We're not going to be able to cover every tax scenario in a video like this, but let me break it down into the basics. If your last dollar falls in the 10 or 12% tax bracket, you should make Roth contributions nearly 100% of the time. You get 88 to 90 cents per dollar and it's tax-free forever. Now, if you're in the 32 to 37% tax bracket in your working career, you should almost always choose pre-tax traditional contributions. You're only getting 63 to 68 cents invested for every dollar. Now, if you're in the 22 to 24% marginal tax rate, that's where the great debate begins. I think pre-tax dollars, traditional contributions, are the way to go if you fall in the 22 or 24% tax bracket. And the reason I say that is because if you think about it, when you make contributions during your working career, every dollar you contribute, let's just say to your 401k, is taxed at 22% if you go Roth. Like in that year, you actually lose 22% of your dollars. Now in retirement, if you fall into the 22% tax bracket, so the last dollars will be the same, there's no difference. But after you retire, you get to fill up the entire 10 and 12% bracket, which with the standard deduction is a huge amount each year. And then some of the dollars fall into the 22. So really, when you think about it, when you stash them away in a traditional IRA, most of the dollars will be converted later or withdrawn later at 10 or 12% taxes, with some being at 22. Clear as mud? Great, let's move on. Impact on your wealth. I'll now share an example on my screen of how 401k plans can make you weirdly rich over time.
All right, I put together this quick calculator. It's just like the ones out there online where you put in a monthly contribution, what your starting investment is, and your assumed growth, and it will show us the ending balance right here, and it'll also show how much of our own money we put in. So let's use that one example, and let's just use the example I talked about earlier. If we put in $500 a month, and remember that only costs us about $400 out of the paycheck, and then the company does that typical 4% match, and frankly, mine and my wife's was 10% from Boeing, but it should be at least 4%. That would have you putting in $750 per month. Starting at zero, you're brand new, and an assumed growth rate of 10%. It's been 14 to 16 in the last decade, but it's been a crazy decade. If you zoom out over 100 years, it's about 10.3% annual returns. So let's just use 10. And in this case, in 5 years, you would have put 45,000 of your own dollars into this thing, and it got you up to 58K. Not too bad. And then let's just drop down, you've been doing this for 20 years. 180,000 has been put in, and you're up to over $500,000 of a balance. And now we got it. Oh, we're so close. Let's just call this $1 million. Come on. You're at $1 million after 25 years, and it's only $225,000 of your own money. You'll realize that with the power of compound, your ending balance, get exponentially bigger than the amount invested. For example, after 1 year, you're only worth $9,400, and you put in $9,000 of that. But after, and I know it's pretty extreme, but after a long career of 50 years, you put in $450,000. And you have about 13 million. And I know this feels exaggerated, but it's not. So like a normal long career, 23 to 65, say 40 years, a little more, you would have put in 360,000 total, and it would be with average performance, truly average. Even lost decades technically make you more rich within those figures because you're buying lower, but even it out over 40 years and you're at almost $5 million. That's only putting 500 of your dollars in. That's assuming no other investments. I'm telling you, when you raise it that little bit, when you get raises, put 100 more a month in. Okay, I'm gonna do 100. I'm adding 100 to this. Instead of 4.7 million, I'm looking down there still. You're at 5.4 million. That's quite a bit of money for just $100 a month. You don't have to be a rocket scientist to make this thing go boom.
Don't forget to update your 401k contributions to take advantage of the new limits if you are currently maxing out your 401k each year. It's easy to get busy and have this simple process fall through the cracks. If you're not at the point where you're maxing out your 401k contributions each year, first of all, that's perfectly fine. You're in the super majority. It's not normal to be able to max it out every year. But I will challenge you to increase your contribution amount by at least 1% every year. I promise the future you is your biggest cheerleader. Check out one of these 2 videos if you want to continue down your path towards financial freedom. Remember, money is overrated. Freedom is not. Thanks for watching, and I will see you here in the next one. Peace.